Major funding for these broadcasts is made possible by grants from Capital One Bank, New York Community Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, Ariel Property Advisors, Dime Community Bank. Additional funding is made possible by grants from AM Trust Title, AVR Realty Company, Avison Young, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Commercial Mortgage, Citizens Bank, CPEX Real Estate Services, Colliers International NYC, Cohen Equities, Collins Building Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Meringoff Family Foundation, the Moynihan Organization, Moynihan Capital Partners, and these friends.
Everybody loves ownership of rental apartments in New York City. There's something mystique about it. There's some reason that it's the preferred asset. So today I've assembled a group of individuals from owners to investment sales to leasing specialists, and needless to say, the man who finances to the bankers. My guests, they include Aaron Jungreis, the founder and CEO and president of Rosewood Realty. Jordan Vogel, who is the co-founder and CEO principal of Benchmark Real Estate Group. Chris Mcgowan, who is the executive vice president of real estate at Customers Bank. And last but not least, our leasing expert, Jay Heydt, who is the managing director for sales and leasing at Madison Realty Capital. So a couple weeks ago when I would see you, you would say that the world was down. The world is up again? People want ownership of real estate? It's a lot of
People
trading?
always want ownership, but I think people were waiting for the market to crash or suffer, and it hasn't really gone down that much as far as prices. And so a lot of guys are coming back in. The 1031 guys are still active. A lot of people are coming with money from Israel. The Israel bond market is fueling, I think, a lot of buys, and people are waiting for it to crash. It's not happening, and they just want to go back in.
Are we at the plateau? Can properties trade for higher numbers? Have we seen all of the value already out of the property?
I think we plateau, but I don't see it going down much right now.
I think we're going to look back in years to come and say the plateau was the fall of 2015. And I've seen prices come down, not materially, but I don't know, 5 or 10% since.
So you'd say in the last 2 years, you've seen prices go down?
Correct. Now, transaction volume's down 50% in Manhattan since its peak, so it's hard to sort of pinpoint exactly where we are in the market. But we're in a period of inertia.
What do you attribute this to?
I think cap rates are too low. I think that cap rates, since the last cycle, we saw them in, 2009, I was buying properties at 5 caps, and then it went to 4 caps, and then 3 caps, and then 2015, you started to see sub-3 caps, and I think the lion's share of the market got tired of a lower return.
Who created that difficulty? Him as the investment sales professional? Him as the lender lending the money on these buildings?
I think it was much more on the equity side than the debt side. I think that there's been an international demand for New York City real estate. I think that it used to be either London real estate or New York real estate, and London's been out of favor for a few years now. And it kept on pushing yields down to the point that it's become much less interesting to be buying New York City real estate based on comparing that to other asset classes. And I think that we're starting to see, I think prices have come down a little bit because, and that's just the beginning of, cap rates normalizing.
What about in lending? Because if you're having sales, you have to have money. You have to have either equity or the combination of equity and debt.
Well, the lower interest rates are a direct correlation to the lower cap rates, right? If you look at how to build up a cap rate or how cap rates are derived.
Why don't you explain to my audience what you just said?
So a cap rate is a ratio used to convert typically 1 year's worth of net income into an indication of value. And there's a few different ways to figure out what a cap rate should be. The best way is the NOI divided by a sales price. And another way to do that is to look at a safe investment, something like a treasury bond or something like that. And the interest rate is another big component. So a treasury bond, interest rates, indexes that we used to figure out how to get these cap rates. And typically the lower the interest rate, the lower the cap rate. There's a direct correlation there.
So in today's market, what are you lending at? How much loan to value?
We're typically looking, as most folks are, at 70, 75%. When we start seeing the 3% cap rates, the 4% cap rates, we get concerned.
What about the debt coverage?
Debt cover is 125, 130. Very concerned about the sustainability of the cash flow. Very concerned about, are these rents sustainable over a 24-month or a 36-month or a 60-month hold?
When it comes to sustainable rents, how do you see it? I mean, you've been in leasing your entire career.
Sure. I really think it depends on the market, meaning I think that in Manhattan, it's very segmented. I think that in Chelsea, the West Village, these are prime neighborhoods, Tribeca, I think rents have sustained for the most part. And I think in other areas such as Midtown East or certain outskirts of Brooklyn, they're starting to feel it a little bit.
What about, one area that I always remember and I always joke about it is the king capital of the Millennium World, Kips Bay, Murray Hill, okay? Sure. Have rents sustained in that marketplace? I mean, do you have any properties?
We have properties. They have not. What we've seen over the last few years is we've tapped out our young tenants. Correct. And what I mean by that is there's been zero wage growth over the last 3, 4, 5 years for young working professionals. And we used to increase rents 5 to 10% a year, and we've gotten to the point that rents are unaffordable. And so I believe that, we've seen across the board, the best case scenario is they've leveled off, and we've seen a 10% reduction in rents, more common in areas that we cater to young people. So the Murray Hill, East Village, Chelsea, West Village, those areas, we're now supplementing, and it's often not talked about because we're offering rental concessions. But if you normalize the concessions, I think rents are down 10% from their peak.
As a banker, how do you take that comment?
It's, he's hit the nail on the head, and it's a concern. As I mentioned before, the sustainability, we're not going to underwrite a full 12 months worth of rent if the landlord's not getting 12 months. And that's going to impact the debt that we're willing to lend. And it's going to impact the overall deal if it's a refinance or a purchase.
As a salesperson, how do you see it?
I definitely agree with Jordan and Chris. However, I would like to go back to what we were talking about before, how the market's gone down 5 to 10%. The Bronx has gone up. It really has. From 15, 16, even last year, you see a trend upward. You see a trend upward in the rents. I'm sure you don't have buildings that you're financing that the rents are lower in the Bronx, right? You'll probably find that in Brooklyn and maybe even in the Heights and prime Manhattan. But the Bronx is still going up. So I think that's one borough out of the other 4 boroughs, or 5, that probably there's a different rule.
The Bronx is going up, and certain parts of the other boroughs are going up if they're near transit oriented.
True.
If you're near the train. Okay, Manhattan's a little different. Okay, you can walk. It's easier to take a Via or an Uber or something else on that situation. But if you're in the Bronx or you're in Queens or in certain parts of Brooklyn, that train is very important. That ferry is very important, right?
Yes.
I mean, for
But,
example,
but as an example, in Clinton Hill, 504 Myrtle, which was a new construction
No
that we
train.
started in 2015, the building got its TCO this past summer in July. There's no train right there.
Right.
And we're pretty much almost 80% leased so far since we launched in July. And, you know, that is a different neighborhood just because of the fact that it sits at the foot of Pratt.
Right.
And we benefited from Pratt Institute.
right, but
But for the
because,
most part,
you know,
people
this-
want to live and work in Brooklyn.
Right,
and that's
but
the other
the Clinton
moving
Hill,
part to this.
As you said, it's right near Pratt.
Correct.
So you have a number of people who could be on the faculty of Pratt,
That's right.
who want to live in that neighborhood. Their families are over there, so they live, work in that specific neighborhood. Astoria, you know, you have the subway over there, but Hallett's Point, which is a portion of Astoria and Greenpoint, you don't have the subway. I mean, do you have anything in the boroughs?
In Brooklyn, in the better parts of Brooklyn. I really agree with what Aaron's saying. You know, in areas like the Bronx, the rents haven't gotten to the point that they've become unaffordable. Our cheapest apartment today is $2,500 a month. And so
In the Bronx, you can get a studio or one bedroom for $1,600 to $1,700.
right. So there's a rule of thumb that landlords use where a tenant should make 40 times their monthly rent. So if you're paying $1,500 a month for rent, you need to, as a quick rule of thumb, that tenant should make
$60,000 a year.
$60,000. The inherent problem is our cheapest studio, which is literally 100 square feet, is $2,500 a month. Who's renting that? 40 times the rent is $100,000. So I can't take a single tenant in my portfolio that's not a six-figure earner.
As someone said to me a number of years ago on the Jewish high holidays, I said, I met this individual, we were at a temple. He said, he was from Atlanta. I said, what are you doing here? He says, my daughter lives in Murray Hill. I said, what does she do? She said, she's in advertising or something. I said, how does she afford it? He said, it's a continuation of one more year of college. So,
Well, parents are
which-
still supporting
right.
that type of
which
share.
which is what
you know,
Jordan, I
yeah.
believe, is bringing out factually,
Sure.
that a number of people are being supported by, you know, some other means, or the subtenant situation. I mean, in the 100 square foot studio, it's difficult to get two people in. If it was a little larger, it could work out.
Correct.
Correct.
Yeah, the Bronx is interesting from the standpoint of the folks that were squeezed out of Brooklyn, went to Queens, and maybe ended up in the Bronx. And the folks that are squeezed out of the Bronx are now ending up in Newark, East Orange, in areas like that. But the Bronx is going to continue to do well as long as the quality of life continues to, to maintain.
You know, we're talking about the boroughs, but one area and a big difference is if you went up to places like Yonkers, which is only a 26-minute, which is a 20-minute train ride, or you went to New Rochelle, over there the rents are significantly down. Have you done any sales?
We actually did 3 sales in Yonkers this year. And the buyers are guys from the Bronx who thought the Bronx was getting too expensive, and so they're going further north. But the vacancy issue is definitely, there is a vacancy issue there. It's about 8-10%, whereas in the Bronx and Brooklyn it's 0, 1, 2% at most.
What type of concessions in today's world do you have to give? Do you have to pay the broker's commission? Do you have to provide 1 month rent, depending on different neighborhoods?
Over the last 18 months or so, and again, it depends on the individual or owner's business plan and getting the highest rent possible. The standard became 2 months free out there on a lot of the buildings that we were marketing, and a lot of our competitors as well as paying a broker fee to the rep that's representing us. So that's pretty much been the standard. I've seen it as much as 3 or 4 months. We're starting to see a little bit of a pullback now, especially on a lot of our buildings where we're starting to stabilize, we're starting to fill them, and as we're getting closer, turning into the next season, that we can tend to pull those concessions back a little bit. But during the summer, when typically concessions should be very low or almost none, they were at its highest level in a while, I think this past summer. don't know if you saw that on your end, but it's
Yeah, I mean, certainly market-wide I saw that. We won't give more than 1 month free because I find that we're just fooling ourselves. If you give 2 months free, some landlords are giving 3 months free, you're filling your entire building with people that can't afford to live there. And so you're just fooling yourself, and when that lease comes up, you're going to be forced to either re-rent it to a new tenant or offer another 2 or 3 months free. So in the event that rents drop to the point that 1 month free won't, we can't keep an apartment filled, we simply drop the rents.
Chris, when you hear this, the 2 months free and the 1 month to the broker, how do you look at that when you're underwriting a transaction?
Well, typically, the core asset class for us is the rent stabilized and to a lesser extent rent controlled buildings that are subject to those regulations, so we don't see a whole lot of that. But when we do see a project that fits our box, that is market rate, that is offering concessions, it comes off the top. You know, it's not counted in the cash flow, and it's going to reduce the overall debt load.
And tenants are expecting a concession. We have a bunch of what I call legacy assets that we bought a while back and we intend to own forever. Our only goal there is to maximize cash flow, so there's no reason to give concessions. And what we found is it's challenging to rent apartments because tenants are coming in saying, this is the only apartment I've seen all week that's not giving a free month. And so even on those apartments, there we're actually bumping up the rent and then giving a month free just so we are perceived to be offering the same free month that our competitors are offering.
People come to me and then people ask me, where are the best opportunities? Where are the best opportunities to own an apartment house, one, and where is the best opportunities for a tenant to get an opportunity of a lower rent or a larger concession? Aaron?
Well, I'm going to tell you, if you're talking about owning an apartment building and getting cash flow, I would maintain it's in the Bronx, cash flow. But if you're talking about long-term appreciation, I still have to say Manhattan and good parts of Brooklyn. And as far as a tenant goes, you know, in Manhattan and Brooklyn, in the primer areas, that's where the tenants are getting concessions, so probably over there. But buyers are asking on almost every deal now, what are the concessions? I never had that question. That's something in the last few months.
What about the Upper East Side? Has the world changed now that the 2nd Avenue subway is open?
Not materially. The prices haven't gone up, in my opinion.
What about your thoughts?
I'm still a firm believer in buying in Manhattan and the better parts of Brooklyn. What we find is after we finish our business plan, and it's really a core deal with no upside, we're still often selling for very sharp cap rates because there's a lot of international demand. And, you know, 4 or 5 years ago it was Russian buyers. You know, a few years ago it was Chinese buyers. Now I'm about to sign a contract to a Spanish buyer who's trying to get his money out of the country. But New York is, or I should say Manhattan is a safe haven. And most international buyers have zero interest in buying in outer boroughs.
It's hard for them to imagine what the outer boroughs are when they're going to their investors at times. How do you look at it as a lender when the buyer perhaps is a foreign buyer? Will you lend to a foreign national who may have a green card, who may not have a green card?
It's a big concern from a regulatory standpoint, from doing our due diligence and knowing where the money's coming from, who's involved with that money. You know, we have a whole another set of items to consider. And if it's somebody coming into the city, they typically would have to be involved with a local player, someone that has the local knowledge to operate the asset in the marketplace.
Who's renting in your properties in Queens? I mean, you have this large property.
Well, the project we have in Rego Park called the Drake, I think that the tenant base is a wide audience. So we're getting anyone from single professionals to families to shares, and that was the hope, that we would get, you know, that assortment of the renter base. There's a big Bukharian community around that area that we're seeing an influx, as well as there are certain key hospitals in the area that have decided to live in our building.
You bring up the interesting topic, which shares. Mm-hmm. As owners, okay, as lenders, and as sales and leasing, how do you look at shares?
Well, for me, I just have always felt that, you know, Manhattan especially is a renter-centric city. And for the last 8-10 years, the share market downtown has always thrived. Everybody wants to be downtown, south of 34th Street, all the way from, you know, the East Village, the West Village, maybe Tribeca and Soho. And it was always very affordable putting 2 or 3 people together to live in those neighborhoods, because like Madison and sure Benchmark, where we are going into these older buildings, repositioning them, adding bedrooms.
Right, but I mean, before your life before Madison
Yeah.
was in the world of leasing.
Yeah.
So I'd say many of your clients were in the share model.
I think then what happened, like Jordan is saying, is that at some point, though, you know, if the incomes are not rising, you know, there's only so much you're going to be able to get in rent. And if you're offering the concessions, at the end of the day, that's really what the rent is. And if there's too much of a spread, it's going to be hard to retain those tenants on the turn. So it's just a matter of at what point does it stop and has to adjust a little bit.
You know, relating to Jordan's comment before of the 40 times earnings of the monthly rent, in essence, there are very few people who could live without a share. Am I? In many
That's
of your-
correct. Yeah, I mean, I have a love-hate relationship with the share market. You certainly maximize your rent per foot when you carve up a 600 square foot apartment and turn it into a 2-bedroom, and you get closer to. It's easier to find 2 tenants with their dual income to afford my rents, but they all move out every year.
So you have a turnover.
We have turnover in our East Village portfolio. We have about 40% renewal rate. 40%.
Wow.
And so when you start factoring in downtime, turnover costs, and brokerage fees, it's costly.
Right. How do you look at it?
I think he just said it perfectly. I mean, I think it increases the turnover, it increases the vacancy, it impacts the cash flow, it impacts the wear and tear to some extent on the property, which could increase your repair and maintenance expense. So all things to be considered.
So here's the question. You know, there's a company called Common. There's another co-living. I mean, WeWork is a co-living idea. What's your thoughts about the co-living concept for the 5-borough, or as Aaron would say, the 4-borough, market with regard to co-living?
I don't understand the premise of wanting to share a living room and kitchen and bathroom with your next door neighbors.
Right, because you don't really know who it is. You see,
Right.
at least when you're doing a share, you traditionally have an idea who's going to be sharing that apartment with you. In the co-living concept, you don't know what the background is at all. I mean, I hate to say, it could be an axe murderer or something like that. I mean, they don't do extensive credit checks on these people.
I think it's like between like an Airbnb and a youth hostel. And I don't think it's something that's so sustainable in most.
It's not working.
places. And it's
that's
not
the
really
answer.
legal.
It's not working.
the
They've
most
tried
part.
for the last 2 years.
Right.
It's not working.
Right.
I agree with Jordan.
I
and
mean,
Jay.
Common is trying it. They've done a couple of buildings.
They've done a few.
They
New
need an
York's a
entire-
different place than the rest of the country. So New York, people love living here, but no one actually wants to talk to a stranger on the subway, or quite frankly, even say hello to your neighbor on the elevator heading to work.
Right.
And
So now you're going into a place where you're basically, unless you lock the door, you have this foreigner next to you who you have no idea. I mean, I agree with you. I think it's a difficult thing. And I know when they went out there, they were going to the banks and saying, we're getting higher rents per square foot than even your rents because we have a higher opportunity. And many of the lenders that I spoke to said, I don't care. I'm not going to lend on this rent, which is inconceivable to continue over a period of time.
Yeah, if it's not in line with what traditionally would be rented at to a normal working family or couple or whoever that may be, the rent's just going to get knocked down to what that level is.
Aaron and Jordan brought up who's buying. Who's new today? Okay, I remember years ago it was the Israelis. Okay, then as you said it was the Chinese. Who are the new players in town? Are they coming from Europe because of Brexit, trying to get their money out? Who do
Well,
you see?
I think Jordan said it before. There are some new people coming from Spanish territories, that's true.
What
Europe,
about South America?
South America, absolutely. But not that much Israel and definitely not China right now. I'm doing one deal with a Russian oligarch, but that's also waned over the last few years.
What's your thoughts about the Jersey City market, where there's a lot of rentals and there's not rent stabilization, but there are different levels of control. Have you looked out in the Jersey City or the Long Island market, Jordan? Or
There are actually a couple of groups who've gone from Brooklyn and Manhattan and are actually buying deals in Jersey City, because you can get deals there mid-5 caps. The banks are lending there. It's a similar system to New York, but it's a lot easier as far as regulation. And there are guys, believe it or not, who are going to Jersey City, and they're chasing cap rates. That's what it is.
We finance some of those folks. I mean, when you see rents at $900 a month, it really can't go too far down from there. These are affordable places. As long as they're showing pride of ownership, keeping up their buildings, I don't think $900 a month in any market within earshot of New York City has anywhere to go but up.
what about competition in the lending market? Everybody is multifamily still the preferred asset class?
It is everyone's base asset class. It is, hyper competitive. It is very much like, Aaron trying to get a listing to sell a building. There's, 10 bidders in the market at any one time. And you have to work very hard to distinguish yourself and get your piece of the pie.
And in the similar manner that Aaron is a successful investment sales broker, would you say a lot of the multifamily financing is coming via the intermediaries or the mortgage brokers of the world?
It is. New York City multifamily market is a broker-driven market. If you have one broker or two brokers, it's going to be dominating, the space. And even our President of the United States uses a mortgage broker.
What about yourselves?
Yeah, we work with a mortgage broker on every assignment. We
And
find we always are able to justify their fee because our mortgage brokers are often going out to 30 or 40 banks to shop rate and shop terms. And so, if you're paying a 50 basis point fee or a 100 basis point fee, you could always justify
You're saving it later on.
Interest rate.
Interest rate. In addition, the good mortgage broker, the average length of time that a multifamily stays on the books, I think, according to New York Community Bank, is like 28 months.
3.5 years, somewhere, 28
Depends.
months to 3.5 years.
Right, on that situation. And a good mortgage intermediary is going to possibly be able to help you with a prepayment penalty and so on.
Sure, that's the business model. They're refinancing these assets 28 to 36 months, putting new debt on the property and getting paid on on that debt.
So in essence, the apple for multifamily looks pretty good. I think we don't have to worry about it. I think what you do have to worry about it maybe is the co-living, as we brought up.
And retail.
Okay, and retail. And I'd like to thank Aaron, Jordan, Chris, Jay, and I'll see you next week.